Give us some investment advice here. You started in that direction with small caps and some duration. If you're putting money to work right now, where does it make sense to do that, given all the uncertainty?
Well, I think Mona said it as well. There's three places that are in distress. One is long duration fixed income. So whether it's treasuries or high yield or long duration bonds that have been absolutely crushed this year, those securities are likely going to provide attractive yields going forward. They're not going to reduce their volatility. They're still going to have a fair bit of price volatility to them. But, you know, this is a time when you can start to think about getting a little longer and moving out of the very short duration, which, by the way, is also paying very well. And you can buy short duration corporate investment grade bonds at 5% or even 5.5%. So that looks pretty attractive as well. But I think leaking out a little bit into duration makes sense. In the equity side, you know, I think you can't abandon the growth world. I mean, the tech world today, or the tech news in the last few days, has obviously been very negative. But there are companies that are not necessarily tech, but are growth companies. They're either consumer-oriented or they're industrial companies that have fast growth. And not paying attention to those is going to miss a trick. That whether they're small cap or mid cap or even large cap, but most likely you're going to find them in the small cap space. So I look at Aperture. Our view is small cap's a very interesting space. The beta's cheap, and it's a place where we're probably going to see the first move when this market recovers.
Well, that's what you said earlier. Small caps come back first. Mona, do you agree with that? And if they come back first, what comes back second? What comes back third? Because that indicates where you want to be and where you don't want to be right now.
Yeah, absolutely. And, you know, Peter's absolutely right. When you look historically, coming out of any sort of downturn or recessionary period, the thing that tends to lead us out are small cap names. And interestingly, this time around, small caps do tend to also be more domestically oriented. And perhaps when you look across the globe, you're seeing a European economy more exposed to the geopolitical issues, the oil and energy crisis. You're seeing an Asian economy more exposed to a Chinese economy that may be slowing. So in fact, the small cap universe is starting to look more and more interesting as well. We probably will have some months of volatility ahead as we stabilize, get through a potential downturn, but I think that is a place to start thinking about. Similarly, you know, across equities and fixed income, we talked about complementing equities. So, you know, think about the stuff that has been more, quote unquote, beaten up this year. There is value starting to emerge in a lot of that. And again, when you look historically, the 12 months after the final Fed rate hike, equities broadly are up on average, and this is back since Fed rate hiking cycle since 1940, on average up about 16% after that peak Fed funds rate. So if you think it's coming sometime in February, March, maybe earlier, there's certainly an interesting opportunity starting to form. And of course, within equities, the other parts of the market, aside from small caps that tend to perform well coming out of a downturn, are the more cyclical and growth parts of the market. And when growth is slowing, you know, investors tend to gravitate towards finding growth in their portfolios. So everything that we've talked about, and Peter and I have probably reiterated a couple of times now, but think about duration, think about quality growth. Opportunities are certainly forming.
Look, I also think that don't misunderstand a rising economy or a rising market that you might have in the next few months for a market that is absent volatility. There's still plenty of shoes to drop, and credit and leverage lending is one of them. And we don't know how the market's going to react to defaults. We haven't seen a significant default cycle really since, frankly, 2003, 2004. 08 was a liquidity crisis, and 2020 was very short. So you could have some defaults here in corporate and in other types of securities, real estate. And I think that that's going to have some effect on the volatility. But investors have to live through that volatility. They can't get knocked out of the market, because if you do that, you're going to miss the opportunity.
Mona, talk about the overall structure, the paradigm, as it were, of investing. We are going, it looks like, from a world low inflation, low rates, into higher inflation and perhaps significantly higher rates. At the same time, there was a good long period of time when it was basically there was no alternative, so people went into a lot of alternates, a lot of riskier things. What happens in this new world? Because it's not like the old world necessarily.
Yeah, that's spot on. And in fact, We all know the TINA acronym, there is no alternative. It served us well, probably from the great financial crisis through the pandemic. We saw a lot of investors pushed out the risk curve in order to get that return that they were seeking. And of course, as rates rose pretty rapidly through 2022, what we did see is a lot of the more speculative parts of the market have started to see the air let out of those tires as well. Think about the SPAC market earlier this year, the meme stock market, even crypto to some extent. We've seen large compression in valuations, large downturn in values overall in a lot of those more speculative bubbles. And in fact, that probably sets us up for a more interesting time in the next 10 years. The one nice thing that's happened over this kind of downturn in markets this year is that valuation compression has come in beyond what we've typically seen historically. So the S&P PE multiple, for example, has come down over 25% this year already. So the valuation correction, in our view, has likely already happened. And that sets us up nicely, but to your point, in an environment where it will probably not return to zero rates, but with growth at 2%, inflation hopefully returning somewhere in that 2 to 3%, yields may also be somewhere in that 2 to 3% range. And so in that scenario, you think about discounting your cash flows at a higher rate. And so really that does put more pressure to prove your business models, especially those business models that expect cash flows in the out years. But the more steady parts of the market that have proven business models, that have proven cash flows, those valuations are starting to look attractive here. And I think that's really what investors will have to think about in this new environment.
I'm a little bit more of a hawk. I think that inflation is going to be in the 2 to 3% range. I think you have to have a real rate of interest. We have not had a real rate of interest since really 2008. So if you add another 100 basis points or so, you're talking about 3-4%, 4%, 5% Treasury. And I think that's normal. That's a real world. And in that world, why would people necessarily look for just private investments? Because in the public markets, then you can get paid 5% or 6%. So if you think about large pools of capital, pension plans, insurance companies, large savings organizations that have large amounts of fixed income, they've been suffering for 10 years with almost no returns. So they're getting pushed to get an extra 100 basis points or 150 basis points with private securities. Now, that market's changing dramatically. And the incremental dollar might not actually flow to where it had been historically.
Well, and just very briefly at the end, Peter, you may not know about that valuation compression that Mona talks about in the private markets for a while.
You definitely won't. That's always been a smoothing operation. But I think it's very important for investors when they look at their balance sheet at the end of this year and they think about rebalancing, that they consider what the real values are in their private assets, because the real values are probably lower than what's being reported.
They could use a little mark-to-market maybe in their private asset.
Perhaps.
Okay.